let's continue with looking at the merger model. And so yesterday we started talking about the nature of the merger. I mentioned it was clearly a stock swap, right? Which is an exchange of shares, where Office Depot will be raising shares for the purchase of Office Max. So even though they mention a merger of equals, from a structural standpoint, there is a target, and the target is the shareholders that will be absorbed, and that's Office Max. So we mentioned, based on the terms, that there will be a 2.69 shares, Office Depot shares exchanged for Office Max shares. So we took 2.69, and we want to find out what the number of diluted shares outstanding was for Office Max. Luckily, we had it. Right? They had given us a nice table that did the conversion for us. We didn't have to do that ourselves. So we took the $2.69 exchange ratio times the number of shares to be bought out, and that gave us 249.5 shares that Office Depot needed to issue. That, multiplied by Office Depot's stock price of $377, gave us a purchase of $940 million. So, based on that, we need to think about what are the appropriate uses and sources of cash. And you usually want to start with the uses. And so here, it's a little bit cut off, but it says purchase price, equity value of Office Depot shares offered. That's what the purchase price is. This is the value of the shares to be raised, of the Office Depot shares to be raised to buy out Office Max shares. That's the 940.5, right? That's the number of 940.6. That's the number that we've calculated on the left here, 940.6, right? So the question and the difficulty comes in is, what's going on with the net debt? So this is always a little bit of a mystery, but there are some things we can infer, right? What is the nature of the situation? How can we determine what the nature of the net debt is? Well, I mean, just given the situation, given what we learned in the past about how net debt can be handled, just generally speaking, forget just Office Depot. Well, I guess you can consider Office Depot Office Max, but what are the considerations for net debt, first of all? What about the terms of the debt?
Well, whether or not that's paid down.
Yep, and then how do we help narrow that down, that determination down? Well, but there's other ways just by understanding the structure of the company, right? Well, there's public or private, right? And in this situation, and what difference does it make?
Public, we're going to pay it down usually.
In public, well, in public we are required to maintain responsibility. Responsibility can't go to the shareholders. Shareholders are gone. But maintaining responsibility means what?
Absolving the creditors, the lenders.
Absolving the...
Like either... I mean, if the covenant says pay it down, you pay it down.
You got to look at the covenants. Yep. And if the covenants say pay it down, you got to pay it down. And if the covenants don't say pay it down, what can happen?
You either pay it down or absorb it in the balance sheet.
Or you combine it into your own balance sheet. Right. So in a public acquisition, if the target company is public, number one, as the buyer, you have to maintain responsibility of the debt. In a private company, you can leave the debt in an empty shell. It's done sometimes, part of the negotiations. In a public company, the public company is getting completely absorbed. You're assuming that the public company is getting completely absorbed. And we're assuming that because we're buying out all the shareholders. We have to be responsible to the acquirers. That responsibility either means raising additional funds to pay it down, one, or two, either we don't raise additional funds to pay it down, which means it stays on their balance sheet, and when we do the consolidation, it gets consolidated into our balance sheet. And so that's something that we do a little bit of research for to figure out how that's done. Now, I mentioned in the beginning there's a way to infer what could potentially happen. And looking at the SEC filings, let's see, this is, I got to pull up the S4, but I think it's back to the page that I was at, 170. No. Looking at the SEC filings, 170. that's not really 170. That's when establishing the purchase price. Here it is. So this is what's being raised, right? $940.952 million, right? So it's about a $1 billion deal, right? If you look at, does this open the news release? They talk roughly about the agreement of the terms. Stockholders will receive 2.69 Office Depot shares for each Office Max share. They don't really talk about, here it's 2 meters. So a common press release, I should have pulled up another example, a common press release would say, and we'll see this with Heinz, that the company A will buy company B for, maybe 10% premium above current market trading value, reflecting a purchase price of $1 billion or a total consideration of $2 billion, including the assumption of debt. Right? So commonly there'll be an indicator that they are going to absorb the debt. Commonly. If there's no indicator, it doesn't mean that they're not going to. There's other things you can look at. But the first thing that you look at is, within the context of the transaction description, is there an indicator? Now, one of the biggest indicators that they might not be raising additional funds to pay the debt is the fact that it's a stock swap. So the 2.69 times the target shares, the $940 million that they've identified here, can only go to buying out the shareholders because of the nature of the way that a stock swap works. Right? There's no room for additional funds to pay out additional debts. They could go and raise debts above and beyond the 2.69, but just knowing how these things are written, they should state that. Right? If there's going to be a significant amount of more funds expended above and beyond the 2.69 stock swap, they would mention somewhere additional consideration for debt. But they don't. Tomorrow I'm going to pull some other M&A press release. We'll see it in Heinz. I pull up Heinz. I got to download it. We'll see. So, first of all, if it's a stock swap, and you should, I think you maybe should be more familiar with that with the ones that we're doing on the board. Like a lot of times we'll see company A buys company B for 0.5 times company A shares, and sometimes people ask me, well, is that debt or equity? It's definitely all equity, right? There's no room for additional funding there to pay down the debt, right? Because that's a stock swap. That's kind of the way I'm translating it into this. That's one indicator, right? If they said, as a second sentence, they will be raising an additional whatever in debt to fund target company obligations, then you know that's what they're talking about. They're talking about that debt. There's no indication about debt. Yeah, Marshall.
What if you're a company like Apple that has tons of cash and you can actually pay off the debt on going about raising any extra fund?
They would still mention it, right? Because right now they're only focusing on equity. So even if they had mentioned vaguely, and they couldn't do it, again, they couldn't do it in the stock swap. The funds here must go to the shareholders, just the way the stock swap works. But if it was a acquisition of the company's outstanding shares at a premium, then they would say the company is raising $5 billion to acquire target company shares and all other obligations. There's no mention of other obligations of the company. So that's clue number one. They could even vaguely say obligation. If they didn't mention any wording about obligations, I mean, not like considering obligations. Right? It's difficult because this just takes kind of a little bit more, reading more of these and getting familiar with the context of it. And usually, if you want to be conservative, if you're unsure, the conservative method is to just assume they're going to pay down the debt, because that's more costly to do so. It's always easier to just to assume that, and you can easily just hard code it with a 0 if you realize you were wrong and they're not going to pay down the debt. Just take the whatever net debt you assumed in the uses and just hard code a 0 over it, and that'll flow through the whole model. So you don't have to spend too much time considering that, but it's easy to infer just from the wording whether they're going to absorb the debt or not. The second good indicator, and I didn't mention this in the book because it got too messy, but if you keep scrolling through the proxy document, they will make a quick pro forma combined analysis for you. So this is what we're going to try to replicate, although we're going to do a full-scale model. So we're going to hopefully replicate this in a little bit more detail. Not to say that they don't have that, but this is all they're producing. This is Office Depot, this is Office Max, this is the combined. These are their adjustments. They also have a balance sheet. And if you look at, let's say their long-term debt, which is the big bulk. Long-term debt, 485,252. They're basically, okay, so this is very small, but if you read note E, these are like fees and things like that. They're basically keeping the debt on the balance sheet. You would see a negative 225,692 if the Office Max debt was being paid down. Here's Office Max debt that Office Depot didn't have. They're keeping it on the balance sheet. They're actually raising, this is something else if you read in the notes. This is some additional refinancing of debt. So you can infer from the balance sheet proof that they're keeping the debt on the balance sheet. These are their balance sheet adjustments. Now the reason why I didn't put this in the book, and the reason why is if you look into the balance sheet adjustments, there's really two types of balance sheet adjustments. There's the transactional adjustments that we've gone through with the arrows based on the sources and uses. And then there's, you get, pursuant to a merger, you got to get like a big, like an Ernst & Young to come in and vet the acquired financials and target financials. And there's always write-ups, write-downs, writing off bad receivables. There's all these other little adjustments that go behind the scenes, above and beyond the transaction adjustments. So a lot of people look at this as an analyst, think about transaction adjustments and say, well, this has to match exactly. It's never going to match. These are based on changes in accounting rules. Maybe Ernst & Young come in and say, well, whoever audited your financials before, they did a bad job. We got to redo everything. All of these adjustments are based on a ton of different things that you're never going to be able to back into. The transaction adjustments that we talk about are, or the balance sheet adjustments that we talk about are just the transaction adjustments, just based on where the fund's coming from, where they're going from a larger scale. So this can be useful if you kind of read between the lines and say, well, where are the major movements? In other words, things like saying, all right, cash is going away on top. Yeah, the target debts are basically staying on, right? But this, you can't expect to back into this in explicit detail. So that's why we're not going to use this to try to match. But this would help us give clues into, from a high level, where the structure is going. Does that kind of make sense? So in other words, from the context from the press release, there's an indicator that they weren't going to pay down debt because they made no mention of it. Although that still isn't a sure way to tell. The fact that it's a stock swap, if they were going to pay down additional debt, there's no indicator telling us how they're going to raise the funds for those additional debts, and they should. They're also going to raise a revolving line of credit of whatever, to fund additional debt obligations. They would say that in the press release if it was significant. And Office Max is significant debt. So the fact that none of that was there was a clue to me that they weren't paying down the debt. And then when uncovering the balance sheet adjustments, seeing that these debts are, proving that these debts are staying on, confirmed it. We'll see in Hines where the opposite happens, and you can tell right from the press release. Any additional questions on that? Okay. So the reason why I want to go into that in detail is because we're now at the uses with net debt. In this case, I'm going to hard code it 0. They're not raising additional funds to pay down the target company's net debt, meaning the net debt's going to just stay on the balance sheet. Now, transaction fees, this is something that's never going to be reported. I would never make it 0, just because there are going to be transaction fees. And the lease as an analyst is important to put in the functionality to handle it. The question is, what could it be? And it could be really anything. In an M&A deal, it could be anywhere from 1 to 3% of the total purchase price. If the deal is a multi-billion-dollar deal, it could be from 0.1 to under 1% of the purchase price, because it's a big deal. This isn't a multi-billion-dollar deal, but it's a $1 billion deal. So I just used 0.5%, which is a median. Who knows? There's really no indicator. But in the book, I gave you ranges of the size of the deal and what's maybe kind of a standard ranges on the street. So I used 0.5% of purchase price. It's almost kind of random. I don't know what to say to that. See, we had this problem yesterday about the model being slow. I wonder if it's something buried in here that's... And so the transaction fees are going to be 0.5 times the purchase price, which is 4.7. And again, you're going to face these things as an analyst where there's a lot of, just don't leave it out, just make some sort of assumption and highlight it yellow and say, well, let me, as more detail comes through and more press comes through, you'll be able to hone in on those numbers. So the total is going to be the purchase price plus the net debt plus the transaction fees. These are the funds to be raised. Take a second and get through to that. Question on that. That's the uses of funds. Real simple. We've done this a lot. 3 major categories. The sources, where are the sources going to come from? That's a stock swap, right? So clearly the purchase price is going to come from the equity, 940.6. Right? There's many different variations of how you can set up the sources, and it depends on the type of the deal. In the stock swap case, purchase price is the equity, and we know that from the examples we did on the board. In the template, it was 50% equity, 50% debt. I've seen it done that way too a lot. That's when we're doing a combination of debt and equity. We'll see that with Heinz. It's a percentage of debt and equity. In the Heinz S4, they gave us the sources, which was nice. So you got to kind of play around with what's, the information at hand. And you have to kind of be able to understand the nature of the transactions to kind of guesstimate where it's going to go. Now, the debt and the cash, so we have 2 things here. We have debt and we have transaction fees. So we got $4.7 million additional to source, right? So the question is that going to be sourced with debt or with cash on hand? And that was kind of a toss-up. So what I had done was, so I looked at Office Depot, who's going to be funding this, their company, and they had about $700 million in cash, right? $750 million. It seemed kind of silly to me to have to raise $7 million in debt, right, for phase. So I assumed that $7 million is going to come out of cash on hand. Now you could have argued with me and said, well, it's cleaner to do debt for whatever reason. It's not going to change the model, but it's such a small number. But so what I had done was I had assumed, because of the small size of the transaction fees, and they clearly have the cash to fund it, that the cash on hand would fund the transaction fees. Now, I consider debt a different story because the debt that the target company had, if it were to be paid down, was significant. How much did they have? I don't remember how significant. And again, now I'm just speculating. It doesn't really matter. They had 735. They already had over $1 billion, more than cash they had, right? So in this case, I wasn't going to use cash on hand. And you don't want to use cash on hand in a merger and acquisition such that the cash is zero, right? If Office Depot has probably been, you can look at their history, trying to maintain at least $500 million in cash, just briefly looking at their history. So I don't want to assume that they're going to pay that debt down in cash. $7 million is nominal. But if I were to, the way I'm thinking about this is, if I were to realize that my assumptions were wrong and that they were going to pay down some or all of the target debt, right? To have that flow into cash on hand might put Office Depot into a insolvent state, right? Because the debt they have is greater than the cash. So I'm going to assume that they will raise debt to pay for debt if they were to pay for debt. They will refinance. Does that make sense? Debt's going to be handled from debt. Cash can be handled from fees. Real simple. Sources match the uses. And so these little things, percentage of total capital, just want to see how much equity they're raising versus debt. It's going to be almost 100% equity. But so what I'm doing here is just taking the equity being raised divided by the total sources. It'll be have more significance in the buyouts and things like that, right? And for the debt, it's the debt being raised divided by the total sources, and the cash being raised divided by total sources. It's a 99.5% equity. Makes sense, right? Which should give us a total of 100%. Let me save this. Choke, do you want this on the flash stick? Where we're at?
This is the one that you sent.
It's the one I sent yesterday, except we just did these little tweaks here. We didn't do too much yet.
Yeah, we did.
Yeah. Okay, let me grab a flash stick. So we can now go to the consolidated financials, where the consolidated financials is like the template revenue all the way down to net income. I'm only doing a 5-year model here. And what we want to do is literally add together the acquire and target revenue all the way down to net income like we've been doing. So let's do that. Let's do that line by line. A little repetitive, but there's some important things in here that we have to continue to model. So revenue is simply going to be equal to Office Depot revenue plus target company Office Max revenue. Copy that to the right. Now we can calculate the year-over-year growth, 2014 divided by 13 minus 1. So pretty low growth, which is interesting, actually. I'm surprised at that. Who's driving that? Yeah, Office Depot is very low. Gotcha. Office Max is a little higher. Right? We continue. COGS, acquire plus target COGS. Office Depot COGS plus Office Max COGS. Copy to the right. And let's back calculate what the implied percentage of revenue is by taking cost of goods sold divided by revenue. copy to the right. So you guys should be familiar with putting together an income statement. And gross profit is revenue minus COGS. And we can calculate the margin by taking gross profit divided by revenue. Pause for a second. Key here, because if you look at the structure of operating expenses for Office Depot and Office Max, there's store, warehouse, operating and selling, and there's general and administrative. Office Depot has store, warehouse, operating, selling, general, administrative. Office Max has store, warehouse, so it's the same structure. It might not always be this way. Office Max could have 5 operating expense line items, and Office Depot could have a very different 3, right? So in that case, it's up to you. I mean, really what we care about is the total. You know, if you think about where this is going to go in our model, it's probably just gross profit, if gross profit, and EBITDA that's going to go into our output and our presentation and our pitch books and things like that. So what I recommend doing is just list, I think the easiest thing is just list the 3 Office Depot line items and then the 5 Office Max line items and just list them independently, because all we're going to care about is adding them up to get the total. You know what I'm saying? Just list them all. In this case, it was easy for us because we have matching line items. So in other words, if, you know, the way I would do it is operating expenses, Office Depot OpEx, Office Depot OpEx, Office Max OpEx, Office Max OpEx, and then total. And it doesn't matter. We're going to have gross profit minus total equals EBITDA. So I would just list all of them. We're basically combining them all into one spreadsheet. That's the way I do it. In this case, and then combining where you see that the line items look the same, right? The other thing you can do is you take total OpEx and have it equal to Office Max 1, 2, 3 plus. I prefer to be as explicit as possible. So in this case, it was easy for us because we have line items that clearly match. Store, warehouse, operating, and selling equals Office Depot, store, warehouse, operating, selling, plus Office Max, store, warehouse, operating, selling. And same thing with general and administrative. I'm going to have Office Depot, general and administrative, plus Office Max, general and administrative. And I'll still calculate the percentage of revenue of each just for tracking, SG&A divided by revenue, here. And here, the line item divided by revenue. We can copy this to the right. Make sure you got that. You guys okay? Everyone have this? Post-merger cost savings. So in this case, there is an indicator that there's going to be a little bit more detail in the press release. In the press release, what happened to my other things? What do I? In the press release, there you have just close it. It says here, combined company position for sustainable long-term value creation, including anticipated annual synergies of 400 to 600 million. So they are anticipating synergies. It's not all the time that they do that. And they list it as one of the key bullet points of the merger. Well, this is going to be a big value creator here. I guess it makes sense. They're two very similar companies in terms of operations, right? Do we talk about, is this a horizontal or vertical acquisition? No, we didn't. It's horizontal or vertical? Why?
We're not acquiring anybody that's up or down there, so I think.
Not up or down the supply chain, and more specifically, why is it? That's why it isn't.
Well, it's not gonna do the same thing.
They're acquiring a competitor, somebody in the same market, somebody that's producing the same type of product. This is clearly a horizontal acquisition. Good. Okay, so if you go to the S4 to try to get more detail, I'm just going to do a quick word search on synergies. Synergies are cost savings. And I expect you guys in a similar situation to spend a little more time than what I'm doing now, but I'd spent more time previously. Synergies. And just to save time, it's actually, yep, this synergies. Next. And I think, yeah, okay, this is it. They don't get into any more detail. The expectation, based on estimates by Office of Office Max Management, prior to execution of the merger agreement, that the transaction will deliver $400 to $600 million in annual cost synergies by the third year following completion of the transaction. So they're going to hit that mark by 2013, 14, 2015, because the first year of the merger is 2013. We're assuming in this situation. So I suggested, well, do we do 400, be conservative? Do we do 600 and be aggressive? I'm going to assume the midpoint, but just have it so we can have a switch later on to say what does the bottom end of the scale mean for our creation illusion, top end of the scale, or what if we have zero synergies, what does that mean for our creation illusion? So we're going to assume by year 3 they're going to hit $500 million. So there's a lot of ways to do this. So the way I did it is in year 3, I hard coded in 500. That's what they're getting in year 3. But in year 3 I assume 500. Yep. And so, sorry, it's negative 500 because it's a cost savings. That's why it's great. Okay. And then in 2013, I'm going to assume that they're going to hit a third of that in 2013, 2/3 in 2014, and then they're going to achieve what they said by year 3, what they set out to achieve, and I'll just continue going forward. So 2013 is going to be 1/3 times the 500, or 500 divided by 3. And in 2014, it's going to be equal to 2/3 times the 500. Right? So that the only thing we have to change is this. When we start to run our assumptions and drivers, and we just have to change, we change this to 600, this is all going to kind of climb accordingly. And 2016 is just going to be equal to the year before. Right? Any questions on that? You guys got that? With the formulas, did I go too quickly? So always interesting to track what that means as a percentage of total OpEx. Now somebody could say, well, it's probably mostly SG&A. I want to see a percentage of SG&A. But when I read further, they were consolidating some SG&A, and also some stores and warehouses are being consolidated too. So they're really finding synergies in every area of their operating expenses.
Well, like everything else, but it's not that explicit. You have to just guesstimate the synergy percentage of whatever.
Good question. What's unique about this case is that they were very explicit about their SG&A, which is an indicator that's a big driver of the merger. A lot of times they're not explicit, which in a way that means that it's not a big driver of the merger. I would still add a line item in there, assume some sort of minimal percentage. So as an analyst, you're at least considering all the details. Make it like 0.5% or 1% of SG&A. That's the way you traditionally do it. And just make sure you're highlighting it and saving that for later. So part of the process of the case is, number one, the mechanics, how to put them all together. And then two, how do you know what variables to hone in on that are going to be significant to the case? And you'd probably likely find, if they don't mention it explicitly, if you just assume like 1%, whether it's 0.5% or 1% or 2%, it's not going to really be a major driver. In this case, it's a major driver, and we'll see. So good point. So you're always going to have these types of questions. I think that part of the way I'm trying to teach this, and we'll start to see this when we do this with designs, is how do you know of all the variables up there, how do you know how to hone in on the ones that really matter? You know, otherwise you're driving yourself nuts. So let's see. So actually right now, if we look at the percentage of cost savings as a percentage of OpEx, well, first it's going to be, what I'm going to do is I'm going to take the cost savings, I'm going to divide it by the sum of the SG&A, of the selling and G&A. Take this divided by these two, like this divided by the total OpEx. But this is negative. I want a positive number. So I'm going to do minus this to get a positive percentage, divided by this plus this. That makes sense? Which is going to get a percentage of the total. So I'm going to do negative the cost savings divided by, in parentheses, general and administrative plus the store, warehouse, operating, and selling. Right? So you can see already 3.39% is pretty high. Usually you get to see 0.5, 1%. And as you copy this to the right, I mean, they're expecting 10%. That's a big chunk. This is where their value is going to come from. So I guess my point is, if you were building a model where you saw 0.5 or 1% SG&A, that's not going to be a major driver here. This is a major driver. Thank you.
Yeah, I just know, like I heard that, when they anticipate all these cost savings, the deal goes through, but then when the consultants try to integrate, lots of times all these cost savings are just unrealistic.
Yep. Yeah, absolutely.
Yes. So in your experience, how often have you seen that?
Very, very, you mean, so not only are our cost savings very hard to predict, but they're almost very rarely actually realized. And I wonder how that's happening in this company. I mean, they went ahead and went nuts and now buying Staples, right? I think it depends on the business, right? Obviously, people are very aggressive with estimating cost savings because it just looks so good. I've seen it more often than not that they would predict all these massive cost savings, and they very rarely get realized. And if they do, it takes years and years and years. And that's dealing with poor management, or there are a lot of reasons for that.
So in the bank, we should build this regional model that they go with management.
Yeah, everyone's excited, everyone's aggressive, they want to get the deal done. Yeah, and that's what happens. And then they have unrealistic expectation decision, which is why I like to be conservative. So we'll see. When we zero this out, the deal comes massively diluted. This is the heart of it. And I don't know. How did it really happen? I don't know. Although, to this situation of defense, they're buying a business that is truly very, very similar. It's almost a branding difference. So I do believe that in this case, they will see a lot of synergies. In other types of mergers, like in vertical acquisitions, I mean, synergies are probably harder to come by. Yet they'll still be aggressive. In this case, I think it's a little bit similar because you get how many areas is there in Office Depot next to an Office Max in the same neighborhood, and it's like, okay, they're going to close one for sure and combine the products, right? It's a little bit easier to realize here. Yeah, Marcia.
Isn't it arguable that the guys don't Office Max are very similar in business, that they just acquire a gigantic market share in a particular industry?
Yeah.
So they're going to have huge revenue growth?
Yeah, you could. So I didn't get into that here, but we did talk about it in the template yesterday before you came in, is that in some large mergers of equals, instead of acquire plus target, you might even go above beyond acquire plus target and just assume, all right, because there's even revenue synergies. They might grow at 3%, right, above and beyond, just because the whole combined entity might grow above and beyond the growth of the individual parts. There could be situations like, typically as an analyst though, you wouldn't be that aggressive. But technically, yeah, you don't know. I mean, I would always start here, but somebody could say, all right, some manager could come in and say, then our revenue is going to be 5%. And then you can easily do that. You can easily overwrite this, make this 5, keep this the way it is, make this 5%, and just do this times 1 plus 5%. You can always start layering on top of that. But I know in the S4 they had management growth projections. Management didn't do that. So I'm not going to assume that yet. But good point, absolutely. So the total OpEx is simply a sum of the combined store warehouse plus G&A plus the merger cost savings, which is reducing the expenses. And we can calculate a percentage of revenue here. OpEx divided by revenue. You guys have that? All right, that's a good time to take a break then. It's nice to yeah, let's take a break then. And we'll just continue to build this out. Let me know if you have questions.
Meetings on Thursday. That's why I asked what time I want, which you didn't have to. Here. So there's this thing just, so.
Let's continue. So we were at total OpEx. Now we're going to look at other income. We started looking at other income in the template, talking about how we should handle it. When I say how we should handle it, what do we mean when looking at some of these items? What do I mean? Say again?
Should we assume it's consistent?
Consistent with what?
That the government coming or values.
Well, I mean, either way, they're coming from the acquired target respectively, right? So the projections have been done.
Acquired plus target.
Acquired plus target meaning what? Say again? You sum it? Why would you do that though?
Because it's related to operation.
No, it could be, but I'm trying to extract that right. So, because related to operations,
Is there any more information as far as to what the other income?
what it actually is?
Yeah.
Well, on the Office Depot financials, it just says miscellaneous. Miscellaneous. And then on the target, okay, also the same thing, miscellaneous. I'm not going to do a word, I believe I did a word search and nothing came up. Yeah, nothing came up in the word search. So, but what are we trying to consider? So, right, so it falls in. So, say it again? Well, the interest income has been extracted, and the interest income is down here. That's for sure. So, good thought. But yes, there's the interest income separated. And if it was a standalone model, we'd want to separate out the interest income from other income. And what was it, Walmart? Or no, it was in Costco. We had to separate it out. Right? So we was very You definitely have to do that. So when after pulling out interest income, that other miscellaneous income could be operating, it could be unconsolidated affiliate income. And so the question is, do you bring on the targets or do you eliminate the targets? How do you consider that? If it's significant, then what, Mike?
I said,
Oh, cold.
if it's consistent, because you look at office max from now 0.3 to 0.5.
Right. And what else? Maybe that's what you're trying to say, Marshall. What else?
Well, even though Office Depot is buying Office Max based on the press release, Office Max is still kind of going to be licensed to keep their senior management.
Yeah.
Operations probably going to be the same.
Right.
So the way I look at it is I probably tie it and have it together because it's not like Office Max's operations as a whole are necessarily going well.
Now, so that's the idea. So some of these, the other line items that are relatively undefined, you kind of have to step back and think about what's going on with the acquisition to determine if the lines are going to be consolidated or if you're going to eliminate the target line items. So a lot of line items, it's always static, right? Revenue you're going to combine, costs you're going to combine, right? The whole idea of you're adding everything from revenue down to net income, except for items dealing with target equity and target debt. That's pretty much true. But you're going to face in a real situation like this other line items that you might have to take on a case-to-case basis. And at the same, step back and think about what the line items are and how they're being managed. And it all comes down to what you're absorbing of the target company, right? So I think you mentioned, so because this is above EBITDA, this is still within the operations of the business. And pretty much all of the time, what you're absorbing is the operations of the business. So given that this line item is related to operations, you would most likely include the target companies into the acquirers because you want the target company's operations. That's what you want. So if this line item was below EBITDA, indicating that it's outside of the operations, I might think twice about it. So that's one of the considerations. You know, is it part of the property? Is it part of the core operations, operating assets of the business? Because that is what you are absorbing in any merger. So given that, in the consolidated financials for miscellaneous income, and it's not always cut and dry, right? This is kind of an assumption. I'm going to take Office Depot, miscellaneous income. I'm going to add it to Office Max. And so EBITDA is going to be gross profit minus OPEX minus the other income, which will actually make it a positive. Which I believe is what we want, right? How did they do it before? Yeah, minus. So that's your EBITDA. You take the EBITDA margin and just take a second to make sure you can tie those numbers. So that's what we have, 1501.7. Okay, so now you want to consider depreciation amortization to get from EBITDA to EBIT. Like we mentioned before, depreciation, as opposed to it being acquire plus target, it's going to come from the depreciation schedule. Amortization of identifiable intangible assets, we need to consider that when we consider goodwill. Let's do that when we get to the balance sheet. So I'm going to leave this empty, but still calculate EBIT, which is going to be EBITDA minus depreciation minus amortization. And the margin I'm going to take is EBIT divided by the revenue. And same thing with interest. We mentioned interest expense, interest income. In the mini merger model, it's the acquirer interest only. You know, in this model, it's going to effectively be acquire plus target because we're keeping the target interest. No matter what it is, interest expense, interest income will all come from the net schedule. So we're going to leave it empty here. We'll still have the net interest expense calculation, which is going to be interest expense plus interest income. So I'm going to be sure to pull in the income as a negative to be consistent with expenses are positive, income is negative. And so that EBT is going to be EBIT minus interest. And I'm then going to calculate that as a percentage of revenue. The numbers are going to look the same, but the formulas are going to be different. Let me know if you want to see the formulas. We can look at any one of them. Is okay with that? So income tax expense, we always want to drive from the tax rate, and there's several options. We talked about this with the template. You know, what tax rate do we use? I mean, this is a merger of equals, two big entities coming together to form, well, it's going to predominantly be held at the acquirer, but do you take a weighted average of the taxes to net income of acquirer plus target to get a new blended rate? Or, given that the acquirer entity is going to be the existing one, will everything be taxed at the acquirer entity's rate? That's what you have to ask yourself. And that's probably something that probably will not be known until towards the end of the transaction when you get tax lawyers in vetting the whole situation. So you do have to make an assumption. In this case, Office Depot, their tax rate was 35%. Office Max was 37%. So do you do a blend? Well, the blend, if you do a weighted average, they did in the book, it maybe comes to 34%. So Office Max is smaller than Office Depot. So I guess in stepping back, would that difference really make an impact to our overall analysis, given other variables out there that are going to be more, more impactful, like synergies? Probably not. For now, I don't know if I did the actual calculation. Let's just take the acquirer's tax rate. That's usually what you do 9 times out of 10, because the acquirer entity is the existing entity. So I'm going to pull in the acquirer's tax rate. This is one that we can go back and say, well, if it was 34%, will it really affect our analysis? I'm going to highlight this yellow so we can do that assumption together when we're done. See which assumptions are really going to make a major difference. And so the income tax expense is going to be that rate times the EBT. And our net income is going to be, in 2016, 976.1. Did I do the 1 did here? My calculator. I haven't calculated. But we can do it at the end. At the end, we're going to hone in on the merit. What were the question marks? Which question marks that we vary would really affect our analysis, right? That's what you do as an associate vice president, right? Once you look at the model, once you guys turn over the model, they're going to say, all right, well, where are the holes in the analysis, and which are the ones that matter that we're going to talk about in the pitch book presentation? Just to hone in on, where are the risks? We'll look at that when we're done. Any questions? All right, non-occurring events. This gets a little tricky, like the other. We got to look at, first of all, the non-occurring events that are out there, if any. Office Depot has 3. Recovery of purchase price, asset impairments, loss on extinguishment of debt. Do we or do we not include these? Well, right off the bat, the recovery of purchase price was a one-time item. So I'm going to exclude that altogether. Who cares? It's gone. Loss and extinguishment of debt, also a one-time item. This is what happens if you prepaid debt, right? If you pay on your debt early, it's not good, right? You get a penalty, right? You get a fee. You get charged $12 million, right? So really what's in consideration are the asset impairments of the acquirer. Of the target company, they have, again, a gain on extinguishment of non-recourse debt, another one-time item, and again, asset impairments. So there's acquirer asset impairments, there's target asset impairments. And so the question is, do we include them, do we exclude them, how do we think about it? When I say how do I think about it, what do I mean? What's the question here?
So Office Max can keep their assets.
Right. Is it, are we taking on the acquirer's non-occurring items? Yes, most likely, right? Always take on the acquirers. Are we going to take on the targets? Depends. What are the pros and cons? What's the contention? How do we know?
Could you look at PP&E and the balance sheet?
Yeah, and why? What are you looking for?
I'm looking to see if there's like a noticeable difference that they're basically bringing on board all the assets of Office Max.
Yeah, I mean, the idea is this. So you're kind of hitting on something that's unique to this specific non-occurring event. This non-occurring event is based on the assets of the business that Office Depot is acquiring. So these ongoing asset impairments that's projected, you need to determine, are those impairments to assets that Office Depot is acquiring? How would you determine that? I should go through the notes, things like that. Assuming that Office Depot is acquiring all the assets, what would you assume?
To acquire those target asset impairments.
Yeah.
Also.
Yeah, so in this case, because it's an impairment to the assets of the business, the target business, you're acquiring all the assets, you probably assume that this asset impairment would come in to the combined entity anyway. Most other non-occurring events, if it's not related to the operations or the assets, you probably wouldn't bring it on. Does that make sense? So for non-occurring events, I'm bringing on the Office Depot plus Office Max asset impairments. Maybe seem a little redundant to have total non-occurring events for one line item, but this was just a template. So I had total non-occurring events equal just the asset impairments. If we end up adding more line items, we'll have a total line item there. And so the net income after non-occurring events is the net income minus the non-occurring events. So you should have 827.3. Just making sure this matches. The first time using this part of the work. Yes. What's up with non-controlling interests? Why?
The targets have been gone out.
Yeah?
Probably not going to carry the minority interest in the target, would you?
It depends. We did a stock swap, right? So according to our 940.6 million, we only bought out public shares. That's what's tricky about these cases. If I do a word search on non-controlling interest, keep going. There is a note that reads, there's a note, believe me, that reads on there's a note that reads that the company can elect to acquire the minority interest for $43.7 million.
On top of the 940.
Yeah. So this is a separate transaction. Usually acquiring a minority stake is a separate transaction. Remember I mentioned there's a lot of smaller transactions leading up to this acquisition. So the question is, has that been done? Has that been done? Do we model it in? Do we not? And, I mean, you can read about it in the book. In short, and again, I don't mention balance sheet adjustments because it's too confusing in the book, but you can see in the balance sheet adjustments here. So, first of all, Office Depot has no non-controlling interests. It's just the target company, Office Max. They have 4 in non-controlling interests. So first of all, it's really small. It's really not going to make a difference. But just to be accurate, you can see, this is where I pulled it up, where did I pull it up before? I guess this is it. Yeah, on the balance sheet, right. Here's the acquirer's non-controlling interest, 0. Here's the targets. Here's the new balance sheet. It's staying on. And they did say in the note that the value of it is about $43.7 million. So this is a little bit of 44, but I mean, it's very close. That must be it. So the note read that they have the right to elect to buy this guy out. But that's not going to be part of the 940.6 because the 940.6 is a stock swap clearly for public company shareholders. How do I know that? Because on page 170, this purchase price is based on Office Max common stock, Office Max options, Office Max preferred stock. Nothing there about non-controlling interests. And this is public. This is a public stock swap. So you got to be careful of that when looking at the purchase price. Minority interest guys usually don't come with the standard purchase. So Office Max has non-controlling interest investors. They're going to stay for now. Okay? So for consolidated financials, I'm going to take attributable to non-controlling interest, Office Depot plus Office Max. And later on, if I want to say, well, they bought it out, and then, you know, you might see in a later prospectus, because this is a preliminary one in which the minority interest has been wiped out, They went ahead and they bought the guy out. Then you write it down. It's so insignificant though. It's $4 million. It's not going to affect our analysis. But these are one of those variables to be considered. If this is a much bigger number, I'd be more concerned. Yes, I found it. Okay, let's spend too much time on one thought. But it's here somewhere. I found it. It's in the book. Cut and paste it. Okay, long circles. All right. Next, how about preferred dividends?
Fire on,
Why?
part of the bought out.
How do you know that? Yeah, absolutely. Yes. We know from page 170 that the target preferred shares were part of the shares that were diluted and bought out. We know that because it says it clearly. Office Max Series D preferred stock has converted. They converted it, they bought it out. Series D preferred. It's gone. Target preferred is gone. Bought out. That's part of the 940.6. So there is a little bit of investigating to do. So Office Depot's got their own preferreds. Office Max, 2.1, that's been bought out. So Office Depot will be acquire only. Now there's another complicated piece that I uncovered as going through this, is that Office Depot, the holding company, might elect to liquidate this upon the transaction. And actually, when looking at the fairness opinions, the J.P. Solomon, or P.J. Solomon, who was representing Office Depot, ran two cases, one in which they liquidated their holdings and one in which they didn't. And I was going to put it in the book, but it got too messy. So, but maybe we'll do it. But so this is a little bit larger than the 4. So it does have a little bit more of a consideration to it. But these are the little nuances that you need to consider that make the real case a little bit different than just a template. Right? So net income after the distributions is net income minus 4 minus 32. So this is what we're kind of dealing with here. And so when thinking about the earnings per share, we want to compare the earnings per share to the acquirer's earnings per share. The acquirer is Office Depot. Their earnings per share is 27 and 21. Now, they have two kinds, right? They got basic and adjusted. The basic is negative, so we can't calculate accretion dilution off that. We're going to do it off of the adjusted. We can't do it off of the negative or an NA. So I'm going to pull in the 27 cents and the 21 cents. I think that's the right column. G. Right? I'm going to pull that in as the basis to use for comparison for earnings per share. Right? And so now I want to calculate my own earnings per share. Again, you want to be very careful to make sure that you're calculating it in the same way that the original acquirer is calculating their earnings per share. Earnings per share can be based on net income before non-occurring events, after non-occurring events, before dividends, after dividends, before preferreds, after preferreds. You can't use a different type of formula than the original acquirer, then your numbers are going to be skewed. So where's the 27 cents coming from? It's coming from the adjusted net income. So before non-occurring events, before non-controlling interest. So no matter how we analyze non-occurring events and minority interests and preferreds, it doesn't matter. It's not included in our analysis anyway. So again, these are other variables that you could have dwelled on and spent a lot of time on. Is not going into our analysis. So we're going to take the net income adjusted divided by the basic shares outstanding. Before we can calculate that, we need to calculate shares. Right, so we're going to do this just how we did the mini merger model in the mini merger Excel model, not the paper model. We're going to take the acquirer's basic and diluted shares, Office Depot, the acquirer's basic shares, it's 279.7, and the acquirer's diluted shares. This is their baseline shares, and then we got to add to it the shares that we've raised. Right, so let's just pull it in from the original acquirer. And so now how do we calculate the shares raised? Say again? Not the purchase price. Well, in this case, the purchase price, the equity raised. In this case, that is the purchase price. Yep. So in this case, there's a couple ways to do it. The standard way, the foolproof way to do it that always works is the equity raised divided by the acquirer's stock price. So let's do it that way. However, in this special case, the way the table is laid out, the shares offered is 249.5. It says right there. Office Depot shares offered. That's what it's going to be, right? But the way to always get to that number, the standard way that you should just the newly issued shares is calculated by taking the equity raised can be equity raised in shares, divided by the Office Depot acquirer stock price. It's always going to get you to the number of shares raised, 249.49. And you can anchor that, and you can copy this to the right. Those are the new shares raised. You guys get that? E7 divided by C6. That always works. Obviously, the 249.9 is the same as the number we calculated here. We calculated this number in a little bit of a different way because of the stock swap scenario, but in any case, equity divided by acquired stock price gets you there. And so the total basic shares outstanding is the basic plus the new. The old basic shares plus the new shares gives us the total shares raised, or diluted share, the diluted shares plus the new shares gets us total shares raised. And now we can calculate the new earnings per share, right? It is now, we've determined it's the adjusted net income divided by the new basic shares, or the adjusted net income divided by the diluted shares. Yep. And then we can calculate the percentage. It's just a percentage change, right? It's the new basic EPS divided by the old minus 1, or the new diluted EPS divided by old minus 1. That's some massive accretion. Why?
No interest in depreciation.
Okay, so yeah, so let's break this down. What is driving this? First, we don't have all our expenses in there. We're not done. We don't have interest expense. We don't have depreciation. Those are big drivers. If you really want to analyze how accurate you are, I could have just done as a shortcut for now, acquire plus target depreciation. And I could have just done, because we're keeping the debt, acquire plus target interest expense, interest income. Just to see relatively. It's not worth doing it when I'm doing it right now. Actually, we can. I'm curious. If I took depreciation, acquire plus target as a shortcut, knowing it'll be overwritten, acquire plus target. If you're not following me here, it doesn't matter so much. That's going to reduce a little bit. We have the amortization of intangibles. We get that form. And then acquire plus target interest expense and acquire plus target interest income. I'm just taking that cell and copying to the right and down. Okay. Good. Right? It drops by 100%. It's still pretty high. Why is it high? Synergies. What if I have no synergies? 0. Model goes up. Look at that. Almost diluted. A little crazy. That's kind of a weird coincidence. Makes a huge difference. Put some amortization in there, it's going to get even more diluted. So the synergies is going to be a major focal point of this analysis. I don't think they're going to get 0 synergies, but it's a lot of risk to base the accretion of a transaction just on synergies. What else is impacting? I'm going to undo that. What else is impacting accretion dilution? I'm going to undo everything. I'm going to put the interest expense back to blank and depreciation back to blank. What else is impacting accretion dilution? What else is making it accretive? Obvious, but something that you shouldn't overlook if somebody asks you.
Earnings per share will be.
The earnings per share is the target. That's the first thing, right? Almost always, well, if the earnings per share of the target is positive, that's going to cause accretion, and everything else should dilute further, with the exception of synergies. So the major drivers are the idea that you're absorbing the target EPS is going to make your EPS accretive, and then the additional costs. When I say additional costs, think about the transaction adjustments. Intangible asset amortization will further reduce that. The new interest expense, if you're raising debt, would further reduce that. New equity raising shares will further reduce that. So when I ask you what's causing accretion dilution here, you'll be asked this in this way in the case study. The framework should be, first, the impact of the target company. In this case, what's offsetting that? Based on what I just said.
The premium offsetting the accretion
Mhm.
of the EPS, the fact that they're raising shares.
The impact of raising shares should offset that. And what else?
The interest in the debt is that they're raising.
No debt raised.
The fees.
Cash impact minimal.
Their earnings.
After the earnings, we mentioned the earnings. We just said it. I just said it.
Which is offset by the interest and amortization expense.
The amortization expense. Make sure you got that. Simple things. It's 4 simple things that it could be. And then what's further increasing it is the synergies. So the general high-level impact is obviously the absorption of the target EPS, and then the 4 major transaction adjustments is what's causing the major impact. Synergies, amortization, interest expense if you're raising debt, new shares if you're raising equity. And so the reason why we identified because of the synergies, this is very accretive, right? You have the accretion from the impact target EPS, but there's dilution from the amortization expense, but the massive synergies is causing big accretion. So let's hold into that in a lot more detail when we go further. Okay, I plan to end here, but we still have a couple minutes, so let's at least look at the cash flow statement and to see what's next to do. Tomorrow we're going to focus on the cash flow statement. I also want to do, some people requested another DCF example. I'll do another DCF example, get the valuation. So we always start with net income. Net income is going to come from above, but the biggest question in the real merger case is, what net income do we use? Net income after non-occurring events, before non-occurring events, after preferreds, before preferreds. Knowing the cash flow statement rule, it's usually always before distributions. You got to look to the acquiring target and see how they're doing it. So Office Depot model takes net income from after non-occurring events, get before distributions. That makes sense to me. Let's see what Office Max is doing. Hopefully it's not doing something different. If it is, then we really have to think about it. They're doing net income, same thing. After non-occurring events, but before distributions. So let's take the same net income. Net income from above, right? Not acquire plus target, because we want the net income that we've created, that flows. Net income after non-occurring events, before distributions. Right? Depreciation, amortization will come from the depreciation schedule and the assumptions tab, but we can still link this in from the income statement, so we only have to plug it into one place. Plug it into the income statement and flows from the income to the cash flow. So depreciation, I'm going to link in from the depreciation expense above. Oops, interest. And amortization, I'm going to link in from the amortization above, which will ultimately come from the income statement. Right? Working capital will come from the working capital schedule. So this whole working capital section, I'm going to leave yellow. We're going to have to figure out a way to create the working capital schedule. We spoke about how to do that. We have to create our own working capital. You always have to create your own working capital schedule because working capital is not something that's reported by GAAP, and you usually look to the balance sheet. So we're going to have to first create our pro forma combined balance sheet, and we're going to have to identify the current assets, the current liabilities that aren't cash, that aren't debt. We'll have to build our own working capital schedule and pull it into here. We're going to do that. So now we're left with standard line items in the cash flow statement: net income, depreciation, amortization, deferred taxes, working capital, and then other non-cash items. So we're left with all these other non-cash items, which I'm not going to do now. But in short, the question is, do we take the acquirers? Do we take the targets? How do we think about that? How do we think about that and why?
Since this is the operation part, we probably would do a mark plus target.
Problem. There's always a case-by-case basis, but 90% of the time, maybe 95% of the time, this is cash flow from operating activities. Actually, it's 99.9% of the time, and I'll explain better why tomorrow. This is cash from operating activities. So, given that you are absorbing the operations, and we know we're absorbing operations because the income statement is acquired plus target, then any adjustment to those combined operations that you combine by taking the acquired plus target will have to be replicated here. So you would do acquire plus target. And the way I do it is I just go to the acquirer, I list all their non-cash items, I go to the target, I list all their non-cash items underneath, and I just pull in everything line by line. I don't go into, okay, this sounds the same, I'm going to combine. It doesn't matter because the individual line items aren't going to go anywhere. It's just all going to go into our total cash flow, total cash, total. So it doesn't really matter. So what I'm literally going to do, and we'll do this tomorrow, I'm going to say, okay, well, what are Office Depot's non-cash items? Let's list them, 1, 2, 3, 4. What are Office Max's? Let's list them one, and then we'll just pull them in together, and then we'll continue. But tomorrow we'll do that, lay out the cash statement as best we can, and then start getting into the balance sheet adjustments. Any questions? Okay, I'll email this, and we'll keep on moving tomorrow. Good.